All right. Hello again, everybody. My name is Mike Rixey. I am the lead options instructor for NetPicks. And I want to spend a couple of videos here walking you through how we're navigating through these volatile markets. It's a question I get on a daily basis right now. Mike, should I be active in the markets? And if so, what strategies should I be using? Well, to answer the first question, absolutely. You need to be active. If I look at the past 20 years of my trading, some of the best stretches that I've ever seen are during periods of downside pressure. When markets sell off, people panic. Things escalate quickly. There is definitely money to be made. I think the worst thing you can do right now is go to the sidelines, fall into that trap of believing all the negative headlines. And you turn on CNBC, Fox Business, Bloomberg, they're all talking through how dangerous the market is. I couldn't disagree with that more. There's opportunity here as long as you're managing your risk and staying disciplined to a system. I'm going to walk you through some of the strategies that we're using on a very regular basis to take very safe trades and generate some really impressive returns. So let's jump in and let's talk about Expedia. This is symbol EXPE. I mentioned volatility has returned in a big way. We've seen a lot of stocks get hammered here lately, and it's leaving a lot of interesting opportunities in the months to come. I personally don't believe the volatility is going anywhere. That's one of the reasons why I don't want you to go to the sidelines, because who knows when this thing is going to settle back down. You could be on the sidelines for months. That's no place where I want to be. Want to be active. So we want to take advantage of these moves, but there's a couple of tips that I want to give you for these types of markets. First of all, we have to stay diversified. Even though it feels like everything's moving together and everything's moving to the downside at the same time, it's not always going to be the case. We're not always going to have highly correlated markets. You're definitely going to have stretches where you have certain sectors or certain areas of the market outperform and others underperform. You want to get exposure into as many areas as possible. And a big belief for us at NetPicks is taking a larger number of small trades. Instead of just loading the boat with 1, 2, or 3 positions, let's start to take 6, 7, or 8 very small positions, not taking large amounts of risk, but we can spread that capital into many areas of the market. Now, how do we do that? A lot of times people are starting out with a small account. They just want to dip their toe in the water, just get some exposure with very little risk. When I'm going to show you all of these trades that we take on our side, we're talking about a few $100s of risk. Very manageable trades regardless of your account size. So looking at Expedia, we also want to take a look at utilizing different option strategies. A lot of times people just come in, they start trading options, they just buy long calls and long puts thinking that's the safest route to go, and that's what they understand. The problem with that approach is when you buy a long call or a long put, you are solely dependent on the market making a big directional move. Fortunately, we've had some of that here lately, but that's not always going to be the case. In fact, more often than not, we're going to have markets that stay in more sideways type range-bound markets. And that's where you get into trouble just forcing long calls and long puts to work. I'm open to using those strategies as long as the markets give us the green light to do that. So in today's video, we're going to talk about a long put. In the next video, I'm going to actually break down a much safer position, a much more forgiving trade that can benefit from the markets just staying in a sideways pattern. So here on Expedia, this is the 130-minute chart. We have found this to be a really good sweet spot. It's going to give you 3 candles a day. It allows us to identify the swings really well without getting caught up in some of the noise that you can see on an hourly chart or even a 15 or a 5-minute chart. You get into some of those shorter intraday time frames, it's really easy to get caught up in some of that noise. With the 130-minute chart, it keeps us active without being so exposed to these big intraday moves. Well, what we had here on the chart, we have a very specific set of criteria that we look for in all of our trades. And we had an overbought condition right here. We had this move to the upside. Keep in mind, I am not looking to pick market tops and bottoms. I'm just looking for very near-term extremes. I'm looking for holding times anywhere from 2 to 20 days. That's what we classify as swing trade. We got a very near-term overbought condition right here, right on that white dots. That gave us the overbought reading. And that gave me an entry point. That's where my pink dots come into play right here. My entry point identifies a level of interest where if price does start to roll over, that's where I would jump into a bearish position. I also had a target level down below and a stop level up above. Very key in this market right now. If you don't have a plan of attack in place right up front, really easy to overreact to every little move back and forth. Really easy to trade off of emotion. That's a big issue that I'm seeing with a lot of retail traders right now. They're basing their decisions off of emotion, what they're hearing in the news cycle. Very dangerous spot to be in. When I got into this trade right here, when price action came down and touched my entry point, I knew exactly what I was going to do from start to finish. I knew where my target level was. I knew where my stop level was. It takes a lot of the guesswork out of the equation. It allows me to stay very disciplined to my trade plan. So what we did when we came in and entered this position, I knew I wanted a bearish trade. Because the market has been so active, we decided to take this specific trade with an aggressive strategy. We came in and we bought the 105 puts. It was in the September monthly options. We spent $370 per contract. That's my max risk on the trade. I can always take it off early. If I hit my stop, in most cases, I'm going to be able to take a partial loss. But worst case scenario, if I held all the way up to expiration, the trade went against me, I'm out $370 per contract. The benefit here is on the downside, things happen very quickly. And if you get a directional move in the stock and volatility expands, that's like throwing gasoline on a fire. It can give you a very impressive return quickly on the downside. That's why I love utilizing options. A lot of times people get scared away from using puts or getting scared away from playing the downside. I love it because you get the best of both worlds. You get the directional movement in the stock that can help you, but when volatility increases, that's a good thing for us as an option holder like we were here. So fortunately, we did get a move to the downside. We ended up closing out of the trade for a $275 profit. That was a 74% return on our capital. We were in and out in 10 days. I was tracking this trade in 10 minutes a day or less. This is not a market that I want to be stuck tracking all day long. What I have found, the more time I spend looking at markets all day, the more I tend to overtrade, the more I tend to overreact and overmanage positions. You can see during this trade, we had a move to the downside, then we chopped. We actually started to bounce higher, then we rolled back over. It wasn't a straight move down to target. I point that out because on this sideways move or this move to the upside, if I didn't have my targets in place, really easy to say, hey, the move's done with, I'm going to jump out of this trade right here. And had I done that, had I overmanaged the trade, I would have given up a lot of profit potential. Do not want to fall into that trap. Now, there's pros and cons of this trade. The benefit, a 74% return on my capital in 10 days, looking at the market 10 minutes a day or less, that's pretty powerful. That's attractive, right? On the flip side, this was a very aggressive trade. We are fortunate that the market gave us a move to the downside. It's not always going to be that friendly. Had we not seen a move to the downside or had it taken too long, this trade would not have worked out nearly as well. So not a deal breaker. I just have to know that this is an aggressive trade where I'm going to have a higher risk, higher reward compared to some of the strategies that I'm going to talk about over the next few days. So what I typically like to do, and I tell all our students this, the way that I structure my trade plan, I'm around an 80-20 split. The trade that I just talked about, this long put, this is 20% of my portfolio. The long calls and long puts, the more aggressive strategies, I'm going to take them, but it's going to be with a smaller portion of my portfolio. 20% of the trades are looking for these types of moves right here. So what am I doing with the other 80%? The other 80% I like to use with vertical spreads. And I'm going to talk about that in the next video, how the vertical spreads, I give up the bigger profit potential, but in exchange for a much more forgiving trade, a much higher probability success on the trade. And by taking that approach, you get the best of both worlds. So now if the market does stay ultra volatile, we have the potential to make money from these types of trades that we just talked about. If we do start to see more of a choppy stretch going into this fall, the vertical spreads can fill in that gap for me and allow me to make money in a more uncertain type market environment. So let's briefly talk why I chose those 105 puts. What I like to do, a lot of times people ask, Mike, how do I know what option to trade? A lot of times people will come over to a trade page and they'll take a look at Expedia and say, all right, I'm going to go to the weekly options. I'm going to go to the option with 7 days left because they're cheap. They're very inexpensive, right? You get what you pay for. They're cheap for a reason because they have a much lower probability of working for you. You just have to know you're getting a cheaper price, but you're getting a lower quality position. What I like to do in most cases when I'm opening these positions, I like to go out, when I'm buying an option, I like to go to the options that have between 20 and 40 days left to expiration. And then I like to go ideally slightly in the money. I'm either 1 to 2 strikes in the money or 1 to 2 strikes out of the money from the entry point on my chart. If I were to open up a trade right now and let's just say I went to the October 7 options, what I would do is try to get slightly, and actually let's go to the monthly. Let's go to the October monthlies. There's more liquidity in those options. If I go out to the October options, if I were looking to put on a trade right here today, I would come, the stock is trading for a 101.73. I would try to either get slightly in or out of the money. If I went to the 100 or the 105 puts, just take a look here. What I'm looking at is I'm going to take a look at a variety of different strikes, and I'm going to take a look at which ones have the most liquidity. If I can get slightly in the money, that's ideal for me. That's going to give me a higher quality position. I am paying more for those, but I'm getting what I pay for, right? So try to get 1 to 2 strikes in or out of the money. First choice being slightly in the money. If there's not enough liquidity there, we can go slightly out of the money. And that's how I structure my trades. I'm open to trading the shorter term options, but I'm going to cover that in the next video. If I'm going to trade a shorter term weekly option, I would rather use a credit spread. I'd rather get the time decay working in our favor, right? And we'll talk about that in the next video. So again, on Expedia, really great trade, 74% return on our capital. Be open to trades in both directions, guys. I think the movement here that we've seen lately, these moves back and forth, I think they're here to stay. You want to be prepared for moves in either direction. Be prepared just to stay nimble, right? Be open to trades in both directions and be open to managing these trades quickly. Don't swing for the fences on every trade. Am I happy with a 74% return on capital in 10 days? Absolutely. That adds up in a big, big way. So I'm going to wrap this video up here. If you have any questions, feel free to post a comment here on the video. If you have not subscribed to the channel, hit the button here. We'd love to have you track along with our videos here in the upcoming days. And as I said, I'll have a couple of videos out with other trades here over the next few days. So I'm going to wrap this video up here. I'll be back with you guys shortly with our next video.